All right. Well, good afternoon, everyone, and happy Friday. And thank you so much for joining us for this special financial check-in with FAME. We wanted to stay on top of all of the things going on with federal student loans and make you aware of an opportunity, a limited opportunity, and who best to address all of these issues than our colleague and student loan expert, Betsy Mayotte, who is with the Institute for Student Loan Advisors and our resident expert and support when it comes to all things related to federal student loans. And so what we're going to do today, I know that some of you are here for just the quick update, and some of you are here to learn about the Parent Plus loan opportunity. So what we're going to do is kick off with Betsy spending maybe 10 or 15 minutes, Betsy, with just kind of the latest quick update that you want folks to know. And then we'll go into the plus loan opportunity because I know some of you may drop off the call because you don't have federal parent plus loans and that content doesn't apply to you. But anytime we have Betsy with us and an opportunity to hear what she has to say about the goings on at the federal level, we want to give her a chance to do that. So another quick housekeeping detail, if you have questions, you can put it in the Q&A feature. Both myself and Martha Johnston will be monitoring that um, to just, check for questions that we can share with Betsy along the way. But with that, I think we'll go ahead and get started. And then real quickly, because I don't think I actually introduced myself, my name is Mary Dyer, and I serve as Financial Education Programs Manager at FAME. Also with us, kind of monitoring questions, Martha Johnston, our Director of Education. And then Mila Tappan, just back from vacation, is joining, but we're not going to put her in the hot seat for answering questions today, Mila. But she's our Manager of College Access and Outreach. So you got a full support team here today. And with that, I'm going to turn it over to you, Betsy. Thanks for being here.
Thank you. And I hope, again, I apologize. I hope you don't hear that noise. If you do, it should go away soon. And I'm gonna shut off my camera because I have a face for radio today, and my face is not gonna contribute anything to this presentation. Um, Someone else that just joined us is Alice, the student loan cat. If I can't answer a question, Alice can. So we are in good hands. Um, So I'm going to sort of start at the end here. So I'm going to flip through some slides to get to sort of the general update that's not Parent Plus specific. So like, listen, my friends at FAME know that I have been working in the student loan industry since the earth cooled. It's been over 25 years that I've been doing compliance and advocacy work within the student loan space. And I have researched higher education policy back to the 70s. And I can tell you with no exaggeration or unnecessary drama that the current state of things are more chaotic than I have ever seen them in the history of student loans. Now, I'm not saying this to throw people into a panic by any means. I do have faith that in the end, the dust will settle, but I'll be the first to say that right now, for people holding student loans, it can be really confusing to figure out what's going on and what the options are. So if you don't remember anything else from today's meeting, I just want you to remember that nobody should be making any snap decisions based on, a headline or what people are prognosticating, including me, what people are prognosticating about what could happen with student loans. Changes take time, even changes that seem immediate, and I'm going to cover some of those in a second. So again, nobody should be making any long-term financial decisions about their student loans without sleeping on it, at least, and thinking it through and gathering all the information that's available. So with that sort of warning in mind, let's talk about the current state of student loans. I think the thing that is affecting the most people at the moment is something that's been brewing actually since last summer. Some of you might remember that under the Biden administration, one of the many things that the Biden administration tried to do to assist student loan borrowers was they introduced a new payment plan that's based on income. Now, we already had a whole bunch of payment plans based on income, and they were all exactly the same except where they were different. What made this new SAVE plan unique is that for most borrowers, it was going to be by far the cheapest plan, both on a monthly payment basis and on a long-term, how much are these loans going to cost you in principal and interest basis. Unfortunately, several state attorney general's offices filed suit against this payment plan, saying that the Biden administration had exceeded their authority as to what they could do under the law. And this payment plan is said, in a nutshell, they were saying that this payment plan was too generous and went beyond what the congressional intent was. Because of that, we saw an injunction by the courts last summer that essentially put everybody that was on the SAVE plan in a forbearance. They couldn't make any payments. Well, they could make payments, but the payments wouldn't count towards any type of loan forgiveness. And nobody new could get on the SAVE plan. People could apply for it, but the servicers weren't allowed to process it. So that forbearance has been going on since around last August. Then on February 18th, a new injunction went through, and this injunction had much longer arms. This injunction essentially blocked the entire regulatory package that the SAVE plan was under. Now, that regulatory package had other regulatory changes in it that affected all the income-driven plans and affected some other things that I'm going to talk about later that specifically affect Parent Plus loans. And because that regulatory package had changes that affected all the income-driven plans, the Department of Education was forced to pull the application for all the income-driven plans down from the website, and they had to tell the servicers to stop processing all applications for all income-driven plans. Now, that doesn't mean that all the income-driven plans are gone. They are not. Now, so let's be clear, SAVE is sunk. SAVE is not coming back. The only question sort of that's up in the air is who's going to bury it? Is it going to be the courts or is it going to be Congress? And I'm going to talk about that a little bit more when we get to the congressional section in a second. But the other income-driven plans, income-based repayment, new income-based repayment, pay-as-you-earn, income contingent, those still exist. And once this pause is over, which I expect will be in another month or two, people will once again be able to apply for these plans and be approved for these plans if they're eligible. What is at risk permanently is the forgiveness component for some of these plans. For some reason, the court, under this court case, also started to question whether specifically the income contingent repayment plan and the pay-as-you-earn plan should have a forgiveness component at the end. Now, one of the things that all the income-driven plans have in common is that they all have a baked-in forgiveness component if you're on the plan for either 20 or 25 years. And no one's ever questioned it. Income contingent has been around since 1994, and no one's ever questioned this forgiveness component. But suddenly this court is questioning this forgiveness component. So it's unclear if that forgiveness component specifically for income contingent and pay-as-you-earn will come back. And I honestly don't have a sense of which way it could go. And if they do kill the forgiveness component of those plans, whether borrowers who are already on those plans will retain that benefit. What I can tell you with 99.99999% certainty is anybody who has already received forgiveness under those plans won't have it revoked. The judges have never, ever done that, and I definitely don't expect them to do that now. The forgiveness component for income-based repayment, that particular plan, that is safe, and it's not under question because that forgiveness is specifically written into law. The word forgiveness is right in the statute. So if your head's spinning already, let me recap a little bit. Income-driven plans, anybody who's on one other than SAVE, you can keep trotting along on that plan. You can keep making payments. Those payments count towards, say, public service loan forgiveness, and they count towards income-based repayment forgiveness. The forgiveness component for ICR and pay-as-you-earn specifically is at risk, and I don't have a sense of whether that'll come back. SAVE is sunk. We just don't know when it'll be buried. The other thing that's affecting borrowers on these income-driven plans, now that there's a pause, is you're probably aware, if you're on such a plan, that you're required to recertify your income on an annual basis. And because the application's been taken down and because the servicers have been put on what we call a stop work order for the income driven plans, you can't recertify your income. Now, for these plans, if you fail to recertify your income by your anniversary date, they don't kick you out of the plan. You remain on IBR or pay as you earn or ICR, but they do increase your payment to what you would have been paying if you were on a 10-year standard plan. Now, I fully expect that the Department of Education will end up extending the recertification dates for anybody that's due to recertify during this pause. Unfortunately, things like that take a minute. They have to confer with the legal department and the servicer communication department and the overall communications department. They have to get forms changed, and all those things can take a really long time in the best of times. I do know that since the injunction came out on February 18th, the Department of Ed has been having a lot and very intensive meetings to try to make it so the form can come back up sooner rather than later. And so this IDR pause won't last longer than they possibly can they'll get rid of this pause as soon as they possibly can. But in the meantime, I am seeing borrowers that were due to recertify, say last week, getting kicked up to that 10-year standard plan. If you're one of those people, or if you're due to recertify in the next couple weeks, the only thing you can do is contact your loan servicer and request a forbearance. Again, I do expect the Department of Ed to come out with some guidance on this, hopefully in the near future. But in the meantime, again, all you can do is either make the payment if you can afford to, or request a forbearance until they do as I expect and extend these recertification dates, or bring the form back up and allow you to recertify your plan in the first place. Now, if you're someone who's on the SAVE plan, you're in forbearance until at least this fall. And I don't expect that to change. But if you're someone who's trying to leave the SAVE plan and get on a different income driven plan, unfortunately, this pause will mean that you're going to have to wait to change plans until the income driven plan form is back up and running and the servicers are able to once again process those plans. Now, I've just thrown a lot at people, so I'm going to take a breath and check in with my FAME friends and see if there's any questions that have come up about what I've covered so far that I can answer.
No, we've been handling the questions that have come through the chat. So just a reminder to everyone, we will actually share a link to the recording of this webinar. So if you feel like you missed something because you joined late or you're worried because you have to leave early, don't worry. And then we did get one question in the Q&A, and it was spot on timing. Should those currently on SAVE plans switch to a different plan, or should they wait until the forbearance ends in the fall and switch to a different income-based plan? So you actually kind of answered that real time as the question came in.
Yeah, it's a really common, I mean, I get that question all day, every day. And to broaden my answer a little bit, it really depends on the borrower. If you're someone pursuing, say, public service loan forgiveness, the SAVE forbearance doesn't in and of itself count towards PSLF. But there is something called buyback, where after you reach the 120 months of qualifying employment necessary to get your loans forgiven under PSLF, you can submit this so-called buyback request, and they'll figure out how much you would have paid if the SAVE forbearance hadn't been there and make you an offer and you pay it, and then they'll give you credit for those months. Your other choice is to, once they're open again, switch to another plan. The problem is we don't, because SAVE is sunk, we don't know what calculation they're going to use for buyback. So it's possible that riding out the forbearance and planning on doing buyback will be the cheapest option if they end up using the SAVE calculation. But if they don't end up using the SAVE calculation, if they use, say, the next lowest income driven plan, or worse, the 10-year standard, staying on the SAVE forbearance might not be the best idea, and you might be better off switching to another plan as soon as you can. For other people who say, they're not pursuing loan forgiveness, they're just looking for the lowest amount possible per month, you might be better off riding out the SAVE forbearance, because the interest on that safe forbearance is supposed to be backed off, at least the interest that accrued up to February 18th. It's unclear to me from the language in the injunction whether the Department of Ed is going to be allowed to continue to waive interest on that safe forbearance, but we know at least up to February 18th that interest should be waived. So, for people that are just looking to pay their loans off or they need the lowest payment possible, they may want to just ride out this forbearance. But other people that are trying to pursue other income-driven plan forgiveness, that's someone else who may want to switch plans as soon as they're able to switch.
And then Betsy, real quickly, you've been talking about things right as the questions are coming up, so it works out really well. Someone asked a question about the buyback specifically and whether we think it's going to continue to exist. It sounds like I don't know what your thoughts are on whether there's threat that the buyback will go away, but we're still kind of in a holding pattern to understand what the buyback terms will be and the time frame on that. Is that correct?
Yeah, so here's the thing. Buyback is written into federal regulation, and thankfully, it's not part of this save regulatory package. It was put into place in a regulatory package the prior year. So buyback, as it exists today, is not at risk. Now, the Department of Education could certainly choose to go through another negotiated rulemaking process and get rid of buyback, but the thing you need to realize is they can't change regulations retroactively. So, my sense is that legally, even if they did get rid of buyback, periods of time that would be eligible for buyback up until the time they change the reg would always be eligible for buyback, because again, they can't get rid of regulations retroactively. Any periods that would potentially be eligible for buyback that accrued after any future regulatory change that may or may not happen, those would be at risk. But again, based on the way the law is written under regulatory changes, I think any buyback periods would be evergreen, unless and until they made a regulatory change. Now, I'm starting to hear chatter that they're not currently processing buybacks right now. I haven't been able to find out if that's true or not. I actually have heard that, hear that rumor all the time. I've heard it for months, and it has turned out they were still processing buybacks. Now, things have changed a lot in the past 2 weeks, so they may have paused processing buybacks right now. But again, under the law, because this is federal regulation, they can't, bar them altogether.
And then real quick, because I know we're now 20 minutes in, Betsy, and you've got a lot more to cover, but there have been a couple of questions about PSLF. And, is that going away? Is that secure? Maybe speak to that, and then we can head back in to the rest of the presentation. What I wanted to just remind people of, and I'll put this in the chat for you, questions for Betsy directly in her organization. We have a special email set up, fame@freestudentloanadvice.org, which goes right to Betsy and her team, so she can answer questions via email. I'm going to put that in the chat. We're also recording this, so we'll distribute the full webinar to everyone who registered. We've had another question about that. But if you could just touch on PSLF briefly, Betsy, and then we can move into the next slide.
I'm actually going to wait because I cover that. I cover that any minute now.
Beautiful. Thank you.
All right. So sort of the really big news this week is that the administration did a 50%, pretty much a 50% reduction in force with the Department of Education. And I just want to sort of talk to people about what that looks like when it comes to existing student loans as well as future student loans. And the short answer is not much. I mean, the fact that they got rid of almost half of the Department of Education employees doesn't change the terms and conditions for the loans. And I was able to get a hold of a list of about 1,000 of the 1,400 people that were laid off. And most of the people that were laid off were people that were in oversight positions. And also, unfortunately, the people that what I would consider to be the helpers. So, again, just to be clear, the terms and conditions of your loans things like public service loan forgiveness or buyback or your interest rate or any of that stuff, that's written into statute. And none of that changes because there's less Department of Education employees. And the fact of the matter is, most of the work done on your loans is done by vendors and your loan servicers. So, the general day-to-day, you should also not see an effect. The Department of Education is required by law to administer the FAFSA, to issue student loans and grants to people that are eligible. So, none of those should stop as a result of this RIF either. Now, where I do see an effect, and I'm incredibly frustrated by this, is, as I think I mentioned, they seem to have gotten rid of most of the oversight people and most of the helpers. So borrowers that have disputes about their loans, or they think there's an error on their account that they're unable to resolve directly through the loan servicer, your options to escalate that further are at this point mostly gone. We know they've gutted the Consumer Finance Protection Bureau, and specifically they fired the student loan ombudsman at the CFPB. So that resource, although they're still taking complaints, it's unclear. They don't really have anybody to follow up on those complaints. Most of the Department of Ed ombudsman unit is currently gone, and we don't know what they're going to do. They're still taking complaints, but we don't know what they were doing with those complaints. And prior to this, rumor has it that they were like 40,000 complaints behind to begin with. So there's unfortunately not going to be as many resources for borrowers that do need escalation. Now, places you can go, here at TISLA, we do try to help people that have complaints or errors on their accounts. You can also contact your state's attorney general's office, and you can contact your members of Congress. The other thing is, I mentioned they got rid of a lot of the oversight. So the people that were out there trying to make sure that the servicers were doing the right things, that the schools weren't committing fraud, many of those are gone. So I am concerned about future oversight of these entities that are in place, that were put in place in the first place to protect borrowers and consumers from fraud and errors happening in the first place. So that's what's been keeping me up at night with this RIF. Now, the last thing I want to say about the RIF is, thankfully, yesterday, 21 state attorney generals filed a lawsuit saying that the RIF was in violation of statute. And based on similar lawsuits that were filed based on other agencies that have experienced recent mass firings, the courts did come up and put up an injunction for those other agency court cases, saying that they could not go through with the firings, at least until the court cases were heard. So I have very high hopes that that will happen with this RIF as well. And what that will mean is maybe the RIF won't happen at all, or maybe it at least will be postponed for a little while. And, at least if it's postponed for a little while, even if in the end these people, and I really hope not, if these people do still end up getting fired, at least if it's postponed, it'll give the Department of Education time to try to reorganize and find homes for some of these services that they're required to provide that were sort of eliminated by the stroke of a pen by this RIF. So sort of stay tuned on this RIF, but I have hopes that it'll at least be delayed, if not found unlawful altogether. But it certainly doesn't lessen the anxiety for borrowers that have student loans or people that are in school right now and depend on federal aid in the future. All right, so let's talk about Congress. And this really relates to that PSLF question because, as far as permanent changes to the student loan programs, I'm not as worried about what, the education secretary might do or the administration might do, because the fact of the matter is that the president of the United States cannot do anything that's in violation of federal law. And some of you might be laughing when I say that and saying, "Oh, Betsy, you sweet summer child, haven't you been paying attention to the news?" And yes, there have been executive orders that have come out that do appear to be in direct violation of statute. One of those was the one that was issued last Friday, that would make it so people that worked for 501c3s that did work with so-called illegal citizens would be barred from PSLF. He can't do that. PSLF under the law specifically allows borrowers that work for any 501c3, and there's no exclusionary language there, to be able to benefit from PSLF. So at any other executive order that has come out, whether it's related to student loans or not related to student loans, that is potentially in violation of federal law, there have been court cases filed pretty quickly. And so far, the judges, regardless of what side of the sort of policy aisle the judges have sat on, the judges so far have, at least for the most part, put a hold on those executive orders. And I expect that to continue. In fact, there's so many lawsuits that I'm hearing that the Department of Justice is having a hard time keeping up. So I'm not particularly worried about significant changes to student loan programs under the administration. What I am watching closely, and what everybody else should be too, is what Congress does. We're in the middle of a budget reconciliation, and student loans are definitely a topic on there. What I will tell you is that historically, Congress has never removed a benefit from existing loans. And believe it or not, I don't necessarily think they are going to do that now. Any proposal that I've seen that has any kind of legs. Now, that last part's a really important qualifying statement. There's a lot of proposals out there, but a lot of them don't necessarily have any legs. To expand on that a little bit, I've been through many reconciliations, and we're in the stage of reconciliation where they throw everything at the wall to see what sticks. And we're also at the stage of reconciliation where people make outrageous proposals, knowing full well they're never going to pass, with the idea it's a negotiation tactic, right? With the idea that when they offer the proposal that they're really gunning for, it'll be a lot more palatable because it's not as bad as the first one that they said. And that's the stage of reconciliation we're in right now. So again, nobody should really be necessarily panicking about any potential proposals that they hear about. As far as PSLF goes, there's the only proposal I've seen, well, there's a proposal and a half. It's just sort of this broad, vague, let's get rid of PSLF proposal. The fact that it's broad and vague tells me that it doesn't really have any legs. And again, I fully expect that any changes they might make to PSLF would only be for loans made on or after the date of enactment of any such legislation. Yes, Project 2025 talked about doing more severe cuts to PSLF, but I haven't seen anything in any potential legislation. The only proposal I'm watching a little more closely and I'm a little worried about is there's a proposal to make it so all hospitals can no longer be 501c3s. Now, personally, I don't think that's going to go anywhere either. Healthcare has a really strong lobbying. But if it should go through, I think there could be some collateral damage. Now, that's not a proposal that targets PSLF, but we could have some collateral damage going forward where people that, if they do make it so hospitals are no longer 501c3s, people that worked at hospitals, future employment would not count for PSLF. But, you know, if you forced me to give a, sports betting, do I think that that hospital proposal will go through? I'd say maybe 15% of a chance of that particular one going through. What I do think they're going to do is I do think they're going to change the payment plans. But again, I only think it'll be for loans made on or after the date of enactment for any such change. So I think no matter what happens, I think income-based repayment and its forgiveness will still exist for existing loans. I think PSLF will still exist for existing loans. Graduated repayment, extended repayment, income contingent will still exist for existing loans. But again, the forgiveness component of ICR is still up in the air, but that's because of the courts. There is a chance that they might eliminate future graduate plus and parent plus loans, or right now there's an unlimited borrowing amount over the lifetime for those loan programs. If they don't get rid of those loan programs altogether, they probably will, quite frankly, limit the lifetime borrowing amount for those plans, for those programs. If they were to do that, they would start winding that down after the date of enactment. So if they follow their timeline for this reconciliation bill where it gets done by, say, April, which I don't know if that's going to happen, they'd start winding that program down after July of 2025. If they don't get the reconciliation bill done by this spring, but they do get it done this year, I suspect any wind down that could happen would start next summer. And the idea is that people that needed more money beyond what those programs provided would have to go to the private loan market. They also are talking about limiting the amount of annual Stafford loan amounts that could be borrowed on an annual basis. And that would be tied to the median cost of the program. So like if you were attending a school and you were getting a degree in how to train a cat to fetch, and your school charged $60,000 a year for the degree program of how to train your cat to fetch. But the average cost of the degree program of how to train your cat to fetch across the country was only 30 grand, then the amount that you could borrow at your school would be limited to the average cost of the program across the country. And I do think this particular proposal has some legs because there's other proposals within reconciliation whose goal is to overall lower the cost of education. And I'm a big fan of those. I'm a big fan of the idea of proposals that would lower the cost of education. Because when it comes right down to it, that's the issue. Student loan debt is the symptom. And we can do all kinds of things to try to make it easier for borrowers to pay their loans or even do loan forgiveness. And I'm a fan of those too, but they don't solve the problem. So I'm glad that Congress is starting to look at things they can do to lower the cost of education in the first place so people aren't taking on that student loan debt. The proposals I've seen that have some legs would cap the total amount that a graduate degree borrower could get to a total of 200,000, including 100,000 for undergraduate. Undergraduate total limits would be 50,000, of which no more than 23,000 could be subsidized. Other changes I think have legs. Schools would be allowed to limit the loan amounts people could borrow under certain circumstances. Right now, they're not allowed to limit it above and beyond what the statutory limits are to begin with. I mentioned that they're talking about streamlining the payment plans for future loans to just a income-driven plan and a 10-year standard plan. The income-driven plan that they're proposing, the monthly payment amount would be similar to what people currently on pay-as-you-earn or the old repay would be, which would be 10% of your discretionary income. However, you'd only get forgiveness after you'd already repaid back the equivalent of what you'd paid under a 10-year standard plan. So that's nowhere near as generous for low-income borrowers. And I guess I'll stop there because, boy, the time is going fast. And I want to make sure we do have time to cover the Parent Plus loophole. So I guess I'll stop there and check in with my FAME friends. And
No questions for now, Betsy, so you can continue on. Thank you.
okay. And boy, we only have 20 minutes left. So, because I'm such a blabbermouth, I'm gonna skip over some of my slides for the Parent Plus, and I'm gonna get right into the double consolidation loophole. If all the other information that I was going to talk about today can be found on our website, which is freestudentloanadvice.org, and can be found at studentaid.gov under Parent Plus loans. So if you're looking for more general terms and conditions around Parent Plus. And if I have time, after sort of the important stuff, I'll go back to it. Parent Plus loans are the sole legal responsibility of the parent. Now, a lot of families have sort of agreements within the family where the student who benefited from the loan um, agrees to make the payments, and that's fine, but they're never going to be legally responsible for the loan. And that means that any benefits are going to be tied to the parent borrower. So payment plans that are based on income are going to be based on the parent borrower's income. Public service loan forgiveness is based on the parent borrower's employment, and that can't be changed. I mean, you could refinance the loan into a private loan, which is a terrible idea. Don't ever, ever do that, please. And put the loan in the student borrower's name, but then you lose all the federal benefits forever and forever and all the safety nets that federal loans have. So there's literally no way to make the student borrower's circumstance be part of the equation for a Parent Plus loan. Now, Parent Plus loans are eligible for the 10-year standard plan, extended repayment, which extends the term of the loan to 25 years, and that's how you lower the payment. Graduated repayment, which is interest only for the first couple of years. And graduated extended, which not only extends the term, but also makes the payment interest only for the first couple of years. And just to give you an idea of what those payment plans look like, for someone who owed around 60 grand in loans and had a 3% interest rate, which I don't know why I use 3% because I don't know if Parent Plus loans have ever been at 3%, but I guess that's the Pollyanna in me. Maybe someday in the future. Under a 10-year standard, your payment would be $645 a month, and you'd pay back a total of about 77 grand. Under graduated repayment, your payment would start at $366. That would be interest only for the first 2 or 4 years, and would gradually increase until year 10. You'd be paying about $1,100 a month, and you'd pay back a total of about $82,000 over time. Extended repayment, you'd pay $361 every month for 25 years. You'd pay back a total of $108,000. And extended graduated, you'd start at about $290, and then the payment would go up to a total of $508, and you'd pay back a total of $115. One thing I want to make sure you notice here, it's not just about your monthly payment, it's about the total you're going to pay over time. And that's the goal. The goal isn't forgiveness. Unless forgiveness is going to be what means you pay the least amount back over time. The goal is to, again, pay the least amount over time. Now, for Parent Plus loans, you can consolidate and get access to what's called income contingent repayment. And I'm going to talk about that in a minute. But unless you consolidate, you're only eligible for those plans that aren't based on income that I talked about a second ago. Now, what consolidation does is it takes all your individual loans and mashes them up into one great big new loan with a longer term. And that in and of itself can lower your payment because instead of having 10 years to pay it back, you have up to 30 years to pay it back. And again, consolidation does allow Parent Plus loans access to the income-driven plan called income contingent. Income contingent, as I mentioned earlier, it's supposed to have a baked-in forgiveness component after 25 years on the plan, but that particular forgiveness component is at risk due to the SAVE litigation. ICR does, however, count towards PSLF. So if you have Parent Plus loans in your name and you're pursuing PSLF, ICR is an option to get on to have payments count towards public service loan forgiveness. You can consolidate Parent Plus loans by themselves. You can also consolidate them if you happen to have Perkins loans or Stafford loans or Graduate Plus loans that you took out for your own education. You can consolidate all of those together. If you're a parent borrower pursuing PSLF, consolidation is almost always recommended, again, because the best way to benefit from PSLF is to get on an income-driven repayment plan. Now, of all the income-driven repayment plans, ICR tends to be the most expensive for most borrowers, and that's because the calculation is the lesser of 20% of your discretionary income, or, and this one is really wonky, what your payment would be under a 12-year term, and then they subtract this really bizarre thing called an income percentage factor. And that's something that gets published every year. It's similar to the poverty level based on your family size, but it's not exactly the same. The other income driven plans only use either 10 or 15% of your discretionary income, and they take a bigger percentage of the poverty level into account when they calculate it. So that's why for most borrowers, ICR tends to be the most expensive of the IDR plans. So ideally, borrowers want to be able to get on one of the lower cost IDR plans, especially if they're trying to lower their payment or if they're pursuing PSLF. And that's why I wanted to talk about the double consolidation. I'm going to go back to the calculation if we have time in a second. That's why I really wanted to talk about what we call the super secret double consolidation loophole. It's not as secret as it used to be, but there is a loophole. And when I say loophole, I don't mean illegal. This is absolutely legal. And it is actually now written into regulation. But when they put it into regulation, they also put a deadline there. And I put a question mark on that deadline, and I'll explain why in a second. But the way the double consolidation loophole works is that if you put your Parent Plus loans through this loophole, and I'll explain how to do it in a second, the loan then becomes eligible for the other lower cost income driven plans. That includes IBR, pay as you earn, and new IBR. So if you need a lower payment, and especially if your income is low compared to how much you owe in student loans, you really want to go through this double consolidation loophole. And even if your income isn't particularly low right now, and your payment's somewhat affordable, and maybe you're not pursuing PSLF, you still might want to go through the double consolidation loophole if you're planning on retiring in the near future, because you might still want to have access to these other lower cost income driven plans. You might want to preserve that option. And right this second, the deadline to have the double consolidation loophole completed is July 1st. Some of you might be looking at your calendar going, wait a minute, Betsy, we're almost halfway through March. Is there time to complete it? And my answer to that is probably, but don't dawdle. And by don't dawdle, I mean I would start it today. Now, here's how you do it. The idea behind double consolidation, if you think about consolidation as a blanket, you're trying to put two blankets on every one of your Parent Plus loans. So let's say you have four of them, and your four Parent Plus loans, we'll call them Parent Plus loans A, B, C, and D. Your first step is to consolidate loans A and B, and at the very same time, you also do a separate consolidation application for loans C and D. You need to use paper applications for this. You can't, there's no online application right now anyway, but even if that online application comes back up, it's really important that you use paper applications for the double consolidation loophole. So again, using paper applications, you would consolidate loans A and B, separate paper application loans C and D. After those consolidations are done, what you're left with is consolidation 1 and consolidation 2. The next step for double consolidation is to do a third paper application where you're consolidating consolidations 1 and 2 together. So now you've put two blankets on each one of your Parent Plus loans. And now you've done the double consolidation, and now those loans are eligible for not only extended repayment, graduated repayment, ICR, but they're also eligible for IBR and pay as you earn, which are the lower cost income driven repayment plans. They're still also eligible for public service loan forgiveness if you, the borrower, happen to be working for a PSLF eligible employer. The other thing that's really important for the double consolidation loophole is you have to use a different loan servicer for each one of those consolidations. If your head is spinning right now, it's okay. We have all the steps written out for the double consolidation loophole under the consolidation page of our website. We also have a link to the consolidation application. We also have an address for all the different loan servicers. Now, one thing you might notice that trips people up is most of the addresses for the consolidation addresses for the loan servicers, they all say aided, except for one, they all say aid advantage. That's because aid advantage does the consolidation processing for most of the loan servicers. That's okay. So let's say you choose Mohila for consolidation one. It's going to go to aid advantage. Aid advantage is going to process the consolidation, but it's going to go to Mohila. So let's say your first two consolidations, you pick Mohila and Nelnet. Both of those are going to go to Aid Advantage. That's okay. As long as you picked the PO box that goes for Mohila and the PO box for Nelnet, so they're different servicers. So don't let that trip you up. Now, here's why I put the question mark after July 1st. Remember I was talking about that SAVE litigation and how currently the new injunction encompasses the entire regulatory package for that the SAVE plan was under? One of the things in that regulatory package was the deadline for the double super secret consolidation loophole. So if the court decides that that whole package is junk, now there's no deadline anymore. That doesn't mean that they won't at some point initiate a new deadline under a new regulatory package, but they might not. And if that deadline goes away and you start the double consolidation process and you don't make it by July 1st, you'll still have time. Again, I don't know if the whole regulatory package is going to go away. Nobody does, which is why if this is something that's going to benefit you, even though you may or may not have time, worst case scenario, if the deadline doesn't go away and you don't make the deadline, you'll at least have opened yourself up for income contingent repayment. So there's not really any negative reason to start this and not have it be completed in time. So I'm going to take a breath and see what we have for questions about what I've covered so far with Parent Plus.
So we have one question, Betsy, from someone who said they tried to do the double consolidation for Parent Plus, and Mohila stated that it couldn't be done as they now flag them as Parent Plus loans and it carries through. So my question is now I have two IDR loans. Can I consolidate them this year for them to become eligible for ICR, IBR?
Well, if you've already consolidated them, they're already eligible for ICR. If you have two separate consolidations, you 1,000% submit another consolidation application today to take into account those two consolidation loans and pick a servicer different from Mohila. Now, I just want to clarify something though. When people say they have two consolidation loans, make sure they're two actual different consolidation loans. When most people consolidate on paper on their account, it might look like they have two loans. It might look like a subsidized consolidation and an unsubsidized consolidation. That's actually usually a single loan. They just book it in two parts to make sure you get any interest subsidies you may be eligible for. The way to know if you actually have two separate consolidation loans that can now be reconsolidated into a double consolidation is to look at the disbursement dates of those consolidation loans. If the two you have say subsidized, one says subsidized and one says unsubsidized, look at the dates. If the dates are the same, you actually just have a single loan and you can't do double consolidation if you don't have any other loans. But if you have say you have two unsubsidized consolidations, those are almost certainly separate. Those are definitely separate loans and can be consolidated again. Or if you have a subsidized and unsubsidized consolidation with two different disbursement dates, those are two separate loans that you can consolidate again. Now, another life hack, which unfortunately at this point, if they don't extend the deadline, it is too late to do, is if you have already consolidated your Parent Plus and it's a single consolidation, you, the borrower, now bear with me on this because it's going to sound crazy, but you, the borrower, can go back to school for a semester. Go get yourself those credentials in how to train your cat. And take out a single small loan. And then once that loan is dispersed, now you have an extra loan that you can consolidate into your existing consolidation and complete the double consolidation process. Now, again, it is absolutely too late to do that now. By the time you enrolled in school, applied for the loan, got the loan dispersed, we'd be into like May, and at best we'd be into May, probably into June. And I don't want to lead people on that there would be time to finish the double consolidation in that time. And I certainly don't want people taking out more debt and lead you on and think you could complete it by July 1st. But if they do get rid of the deadline because of the SAVE litigation, then that's absolutely going to be an option. What else?
That is it for now. I might have one for the end once if you feel like you've gotten through the slides. But that's it for now, Betsy. Well, I say that.
Well,
Right.
we have one that's related to a rumor. So I've heard a rumor that people have been disputing their loans because violations against FERPA by the current administration.
Oh, bless your heart. And please get off TikTok.
Okay. So that unfortunately is a rumor.
Oh, yes, it is a rumor. And actually what's happening because of this, it's absolutely untrue. Listen, I'm not an attorney, but I definitely researched the heck out of this when that rumor first started coming out. And I did talk to people a lot smarter than me that are attorneys. And if you even Google it online, you'll find this yourself. There's no private right of action for FERPA. So your loans cannot be forgiven because someone who may or may not have had the authority to look at your information looked at your information. And that's a hard stop right there. And unfortunately, what's happening because of this TikTok video is that a lot of people are submitting these FERPA claims, and it's actually tying up the loan servicers and the Department of Education because they have to respond to the inquiries, and they're responding to the inquiries saying, sorry, this isn't a thing. And it's taking up a lot of resources that they don't have to begin with. So yeah, that's 1,000% not true.
Thank you.
All right, so I'm trying to think of in my last few minutes what's the most important things I want people to know about Parent Plus. I guess going back to the income-driven plans, just to get an idea of how it works. So this is the calculation for ICR. But the calculation for the other income-driven plans is very similar. So what they do is they take your adjusted gross income, and if you're married and you file your taxes jointly, they're also going to include your spouse's income. But if you're married and you file your taxes separately, they won't include spousal income. And then they subtract the poverty level based on your family size and state. And then for ICR, they take 20% of that, and that would be your payment amount. So for ICR, where they use 100% of the poverty level, if your AGI was, say, 62,000, they take 62,000, subtract the poverty level for a family size of 4, if that's what you were. I have for Maryland here, but Maine has the same poverty levels as Maryland does. All the states do other than Alaska and Hawaii. So they would subtract the 26,200 from the 62,000. So the base amount of your income they'd be starting off from would be a little over 35,000. So you divide that by 12, that gives you 2,983. And then for ICR, you multiply that by 20%, and that would be your payment under ICR. The other plans calculate the same way, only instead of 100% of the poverty level, they're subtracting 150% of the poverty level. So you're starting at a lower income amount than for ICR. And then for old IBR, they only take 15% of that. And for pay as you earn and new IBR, they only take 10% of that, which is why those payment plans tend to be lower. Parent Plus loans can also request forbearances and deferments to completely postpone payments. Those are only temporary stopgaps. It should not be a long-term strategy, and interest accrues on the loans during those periods. And for deferments, at the end of the deferment, any accrued interest gets added to your principal. So you end up accruing interest off of interest, which is not a good thing. I already talked about most of this. I apologize for the haphazard way. But between the time we booked this webinar and the time we held this webinar, a lot changed. So that's why I sort of had to go in a weird order. That's not usually the way I roll. I don't usually speak this fast, although kind of close to this fast. It's not the usual way of things. So again, it just so many things changed just even in the last week. I had to sort of throw it in at the last minute. Some other benefits, or I would say entitlements that you have as Parent Plus borrowers is, if the worst should happen and you or the student for whom the loan was taken should pass away, the loan is discharged. If you, not the student, but if you should become totally and permanently disabled, the loan is discharged. And this one can be tricky to get because you have to file a police report and you have to show that the money wasn't used to the benefit of the student. You can get the loans discharged if someone forged your name on the application. And again, you'd have to file a police report, and there would actually, in most cases, have to be a prosecution of the person. And you would have to show that you or the student didn't benefit from the funds for the ID theft discharge. If the school closed, and the student wasn't able to complete their degree and they were attending within 120 or 180 days of the school closing, the loan can be discharged. There's also a discharge if you were defrauded by the school. Now, of all the things I told you today that I was not worried about with this administration, this is actually one that I very much am. This administration, we saw it the last time they were in office, they are very much against providing relief to students that were defrauded by their schools. They put a lot of roadblocks up in place the last time, and they're already starting to put roadblocks in place this time. I mean, I think the fact that a big part of that RIF were the people that do oversight for these schools and people that look into disputes is also a big indication of that they also stopped defending a lawsuit that would have boned up the rules and protections around people that were defrauded by their schools. So, people that are attending school now or plan on attending school, you need to be extra vigilant and do your due diligence before you enroll in schools and look for red flags, because I am worried about those protections going forward and how they could be weakened. And believe it or not, another big myth that's not just on TikTok, but it's everywhere, is that student loans actually can be discharged in bankruptcy. Now, I'm not going to lie, it's not easy, but in cases of extreme hardship, they can be discharged in bankruptcy. So that is something else. If you're in that unfortunate situation, don't let an attorney tell you it's impossible, because it's not. And so with that, we're right at the hour. I have time to hang out and answer whatever questions you have, whether it's related to Parent Plus loans, or I can do the best with my cracked crystal ball about other aspects of student loans, of questions that people might have.
So I might refer this borrower to the FAME at freestudentloanadvice.org, but would it have been the case that the department would have automatically moved loans from one servicer to another so that somebody's consolidation loans would have landed at the same servicer, and it's now making double consolidation challenging or not possible?
Yeah, loans change servicers all the time. In fact, there's a switch going on right now. There's a certain servicer who I think, due to errors, may have lost some volume.
Okay.
But if both your consolidation loans are at the same servicer, that doesn't block you from doing double consolidation. You just, as you would normally, you have to pick a different servicer for that last consolidation.
Okay. Okay, I think that might get me the answer I need, but I will also direct this person to contact Tisla directly just in case.
Yeah, but Martha, I'm going
Yeah.
to tell you right now, when I hear that unless it's somebody who just finished the first step and both their loans are sitting in Advantage,
Mhm.
and that's just a case where we're just waiting for one of those loans to move to the other servicer. If someone has two consolidation loans at a single servicer, the first thing I look for is it really two consolidations?
Right, so are we looking at an unsubsidized and subsidized
You got
situation?
it.
Got it. Thank you.
What else?
Betsy, this question about whether or not there's any, this person is looking for some additional guidance or resources about information on consolidating two different disbursement dates, two types of loans owed. It says I have one grad payment. I'm not sure it is a typo, so I might not be following it right.
Where's the question? Is it in the Q&A?
Yes, it's in the Q&A. So I have two grad payment plans and one that goes up in payment every 2 years. So I think the root of the question is guidance that you would recommend to help with consolidating those two types of loans.
I'm trying to read the question for myself, but there's a
And
lot
we
in
will
here.
provide a recording of this presentation. That was part one of that individual's questions. Yeah, maybe if you read it, it'll be clearer for you.
What time did it come in?
1 o'clock.
Just now, yeah.
Yeah.
And it's in the Q&A?
Yeah, I was answering part of it though, so I've stopped doing that so that maybe it shows up again.
Oh, there it is. I only read the first part. Will this
Yeah.
presentation be available? Okay. If there's any info out there for consolidating two different disbursement dates and types of loans owed, I have two, one grad payment plan and one in the group goes up in payments every year. So it sounds like both of them are on the graduated repayment plan. Just one of them might be further along and is beyond its interest only payments. You could consolidate those two together already. There's no, you don't need any special guidance, you don't have to like wear red shoes or click your heels together. You could just consolidate those two together.
Yeah, and if
already.
you look now, Betsy, that individual followed up with a follow-up comment or answer in the Q&A. So if you refresh that or scroll down, you'll see there are two different loans. It wouldn't allow me to do the third step as the Department of Ed had Mohila grab my Nelnet and brought it automatically over to Mohila. Nelnet no longer was being serviced by the Department of Ed. So there was a follow-up.
Use a paper application. If they're two different disbursement dates, so you're positive it's not already a single consolidation, just use a paper application and choose either CRI or Advantage as the servicer. It should go through just fine.
And as we mentioned a few times, the fame@freestudentloanadvice.org, definitely email Betsy along the way as you're going through this process. If you still have questions or confusion, it's a great opportunity to reach out. So let's see, let me just check the.
Someone said, can my own student loans be applied to the loophole? I'm unclear what that question is. If you have Parent Plus loans, you can absolutely do the loophole. If you have your own loans, because you're the student who benefited from the Parent Plus loans, no, you can never consolidate two different people's loans under a single consolidation. Ever, 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 ever. But if you're a parent borrower, but you also took out loans for your own schooling, yes, you can consolidate those together as part of the double consolidation loophole.
Great. Thank you, Betsy. And then there's one last question in the Q&A if you want to grab, and then I think we'll conclude for today. It has to do with the PSLF buyback.
If you get a buyback, the question is, if I get a buyback offer that's too high, can I just pay some of it and apply again later? I think it's all or not. I've actually never had this question before for buyback. I think it's all or nothing. If the amount is too high, I would recommend just not paying any of it and continue making payments under your current plan, and then perhaps consider applying for buyback again later.
Great. Well, I think with that, it's a wrap. One thing I will mention, we do plan to host Betsy again. We haven't quite sorted out the timeline because we are really trying to wait until we have more concrete answers and information about student loans. So we will be hosting another webinar for sure. But the date of that is yet to be determined. The other thing I wanted to mention is that on April 4th, our next financial check-in with FAME, that's Friday, April 4th at noon, same time, we're doing a second part to the Personal Finance Foundations, which will focus on moving from saving for emergency funding, for emergency funds, into investing. So just want to make you aware of that, and you can sign up for that right through the FAME website. With that, I want to thank you, Betsy. Thank you, Martha, for helping to answer the questions. And I appreciate everyone who has joined us today. I hope this was helpful. And stay tuned for another follow-up webinar, and reach out to the FAME at freestudentloanadvice.org if you've got questions. Thanks, everyone.
Thanks, Fame.